What if I told you that retiring in 2007 with $1 million could leave you broke by your 80s, but retiring in 2009 with the same $1 million could leave you with $2 million at 85? Same portfolio, same spending, just 2 years apart. Sound impossible? It's not. It's called sequence of returns risk, and it's the retirement threat that nobody talks about but everyone faces. After managing trillions in retirement assets for 40 years, I'm going to show you exactly what this is, why it matters more than your account balance, and most importantly, how to protect yourself from it. Before we go any further, I'd like to ask you to support this content by liking this video and subscribing to the channel with notifications turned on. It helps us continue bringing you this kind of in-depth financial education. You know, I've spent the better part of 4 decades thinking about retirement. Not in some abstract, theoretical way, but in the most concrete, consequential way possible. At BlackRock, we manage retirement assets for millions of people. Teachers, firefighters, nurses, engineers, people who've worked their entire lives, saved diligently, done everything they were told to do. And the question that keeps them up at night, the question that I hear in every conversation, in every client meeting, in every worried email, is this: will my money last? It's a simple question. But the answer is anything but simple. Because here's what most people don't understand. The answer to whether your money will last doesn't just depend on how much you've saved. It doesn't just depend on how much you spend. It doesn't even depend on what average returns your investments generate over the course of your retirement. The answer depends on something far more subtle, far more dangerous, and far more random than any of those things. It depends on when you experience those returns. Let me say that again. Because this is the single most important thing you need to understand about retirement. It's not just what returns you get that matters. It's when you get them. Think about that for a moment. 2 people, same age, same retirement date, same portfolio, same spending, same average returns over 30 years. But one person retires into a bull market, and the other retires into a bear market. And that difference, that accident of timing, that lottery of market cycles, can mean the difference between dying with $2 million in the bank and running out of money at age 78. This is sequence of returns risk. And if you're within 10 years of retirement, or if you're already retired, this is the single biggest financial risk you face. Not inflation, not healthcare costs, not longevity. Those are all real risks, absolutely. But sequence of returns risk is the one that can destroy a retirement portfolio in the first 5 years, before you even have a chance to recover. It's the silent killer of retirement plans. Now, I know what some of you are thinking. Larry, I've heard about market risk. I understand that stocks go up and down. I've been through crashes before. I held on. I recovered. What's different about retirement? And that's exactly the question we need to answer. Because market volatility during your accumulation years, when you're working and saving, is fundamentally different from market volatility during your distribution years, when you're retired and withdrawing. When you're working and contributing to your 401k every month, a market crash is actually your friend. Prices are down. You're buying more shares with each contribution. Your dollar cost averaging at lower prices. You have time. You have income. You have the luxury of waiting for the recovery. And the recovery always comes. I've been doing this long enough to know that with absolute certainty, the market always recovers. Always. But when you're retired, everything changes. You're no longer contributing. You're withdrawing. You need that money to live on. You need to pay your mortgage or your rent. You need to buy groceries. You need to cover your healthcare. You need to fund your life. And if the market crashes in the early years of your retirement, you're faced with a terrible choice. Either withdraw from a declining portfolio, locking in losses and depleting your capital, or drastically reduce your spending, compromising the retirement you worked your whole life to achieve. This is what happened to people who retired in 2007. The market peaked in October of that year. If you retired then, if you finally left your job after 40 years of work, if you rolled over your 401k and started taking distributions, you walked straight into the worst financial crisis since the Great Depression. By March 2009, the S&P 500 had fallen 57%. 57%. More than half of the stock market's value, gone. Now, imagine you're that retiree. You've got $1 million in your portfolio. You're following the traditional 4% withdrawal rule, taking out $40,000 a year to live on. The market falls 57%. Your $1 million is now $430,000. But you still need $40,000 to live on. So now you're withdrawing not 4% but 9.3% of your remaining portfolio. And every month, you're selling more shares. And every month, the balance is getting smaller. And even when the market starts to recover, as it did in 2009, you've sold so many shares at low prices that you don't participate fully in the recovery. You've locked in permanent losses. You've depleted your capital base. And the math from that point forward becomes increasingly difficult. Let me give you the actual numbers, because they're sobering. If you retired in January 2007 with $1 million, taking out $40,000 per year adjusted for inflation, invested in a standard 60% stock, 40% bond portfolio, by 2025, just 18 years later, you'd have only about $650,000 left. And you're only 83 years old. You might live to 95. You might live to 100. And at the rate you're going, you'll run out of money in your mid-80s. That's the nightmare scenario. That's the retirement crisis we're trying to prevent. Now, compare that to someone who retired just 2 years later. January 2009. Same $1 million. Same withdrawal rate. Same portfolio. But by January 2009, the market had already fallen. You're buying into the recovery at lower prices. Your portfolio still takes the hit, absolutely. But you're not withdrawing at the bottom. You're not selling at the worst possible moment. And when the recovery comes, as it did starting in March 2009, your portfolio recovers with it. And by 2025, instead of having $650,000 left, you have nearly $2 million. Same time period. Same strategy. Different starting point. 2 years. That's all it took. 2 years separated financial catastrophe from financial abundance. And the person who retired in 2007 didn't do anything wrong. They didn't take excessive risk. They didn't panic sell. They didn't deviate from the plan. They just had the misfortune of retiring at exactly the wrong time. That's sequence of returns risk. That's the lottery nobody wants to win. And here's what makes this so insidious, so dangerous, so difficult for people to wrap their minds around. Both of these retirees experienced the same average returns over the 18-year period. The market went up some years, down other years, but the average was roughly the same. In the accumulation phase of life, average returns are what matter. If you're 35 years old and investing for retirement, you don't care about the sequence. You don't care if the market crashes next year or in 10 years. You'll recover. You have time. But in the distribution phase, sequence is everything. The order of returns matters more than the average. This is counterintuitive. It violates everything we've been taught about investing. We've been taught to think long-term. We've been taught that timing doesn't matter. We've been taught that average returns are what count. And all of that is true during accumulation. But it's dangerously false during distribution. I want to be very clear about something. I'm not trying to scare you. I'm not trying to make you panic. I'm not suggesting you sell everything and go to cash. That would be the worst possible response. What I'm trying to do is help you understand a risk that is real, that is quantifiable, that has destroyed countless retirement plans, but that is also manageable if you know what you're doing. And that's what the rest of this conversation is about. Understanding this risk, measuring this risk, and most importantly, protecting yourself from this risk. Because here's the thing that nobody tells you when you're saving for retirement. For 40 years, you're taught to take risk. Buy stocks. Stay invested. Ride out the volatility. Think long-term. Max out your 401k. That's the advice. And it's good advice. It works. I've seen it work for millions of people. BlackRock has helped clients build trillions of dollars in wealth through exactly this approach. But then you retire. And overnight, the rules change. And nobody tells you. Nobody sits you down and says, everything you've learned about investing for the last 40 years doesn't necessarily apply anymore. You need a different framework. You need different strategies. You need to think differently about risk. Instead, what happens? You retire. You roll over your 401k into an IRA. You set up systematic withdrawals. And you keep the same investment strategy you've had for decades. 60% stocks, 40% bonds. Maybe 70/30ths if you're aggressive. Maybe 50/50 if you're conservative. But the fundamental approach doesn't change. You're still treating your portfolio like you're accumulating, like you have time, like volatility is just noise. And maybe you get lucky. Maybe you retire into a bull market. Maybe the first 10 years are good years. And if that happens, you're fine. You're more than fine. You're wealthy. But if you're unlucky, if you retire at the wrong time, that same strategy destroys you. This is what I mean when I say sequence of returns risk is the retirement threat nobody talks about. Financial advisors don't talk about it enough. The investment industry doesn't talk about it enough. Retirement calculators don't account for it. Those simple calculators that ask for your age, your balance, your expected return, your withdrawal rate, they assume returns are smooth. They assume you get the average every year. But returns aren't smooth. Returns are lumpy. Returns are volatile. And in retirement, that lumpiness, that volatility, that sequence, it's everything. I've been in this industry since 1976. I've seen every kind of market. Bull markets that seemed like they'd never end. Bear markets that felt like the end of the world. Crashes, corrections, rallies, bubbles. I've seen it all. And I've watched what happens to people who retire into different market environments. I've seen the relief and the joy of people who retire at the right time. And I've seen the fear and the stress and the heartbreak of people who retire at the wrong time. Same people, same discipline, same portfolios, different outcomes, all because of timing, all because of luck. And the question I've asked myself for decades is, how do we take luck out of the equation? How do we design retirement strategies that work regardless of when you retire? How do we protect people from sequence of returns risk? That's what we're going to explore. That's what I'm going to show you. Because the answer exists. The solution exists. It's not simple. It's not a single product or a single strategy. It's a framework. It's a way of thinking about retirement that acknowledges this risk, that measures this risk, and that structures portfolios specifically to mitigate this risk. And it works. I've seen it work. We've implemented these strategies for institutional clients, for pension funds, for endowments. And increasingly, we're making these strategies available to individual investors. But before we get to solutions, we need to understand the problem more deeply. We need to understand why sequence matters. We need to understand the mathematics of withdrawal rates and portfolio depletion. We need to understand the relationship between volatility and longevity. Because if you don't understand the problem at a fundamental level, you won't appreciate the solutions. You won't implement them correctly. And you'll be vulnerable. Think about it this way. Most people spend more time planning their vacation than planning their retirement income strategy. They know where they want to go. They know what they want to do. But they don't know how to structure their portfolio to survive a bear market in the first 5 years of retirement. They don't know what withdrawal rate is actually safe. They don't know how to create a floor of guaranteed income that covers their essential expenses. They don't know how to think about the sequence problem. And the reason they don't know is because the industry hasn't done a good enough job educating people about this risk. We've focused so much on accumulation. Save more. Invest in stocks. Stay the course. Max out your match. All of that is important. But we haven't focused enough on distribution. On the actual mechanics of making your money last. On the risks that emerge when you flip from saving to spending. On sequence of returns risk. That changes now. That's what this conversation is about. I'm going to walk you through this step by step. I'm going to show you the data. I'm going to show you the historical examples. I'm going to show you the strategies that work. And most importantly, I'm going to show you how to think about your own situation. Because this isn't one size fits all. Your risk tolerance is different from someone else's. Your spending needs are different. Your other sources of income, Social Security, pensions, rental income, they're different. Your time horizon is different. All of these factors matter. But what doesn't change, what's universal, is that sequence of returns risk is real. It's the difference between a secure retirement and a stressed retirement. It's the difference between leaving a legacy and leaving your kids with the burden of supporting you financially. It's the difference between dying with dignity and independence and dying broke and dependent. This is not abstract. This is not theoretical. This is not some edge case that only affects a few unlucky people. This affects everyone who retires. Everyone who depends on a portfolio to fund their living expenses. Everyone who's making the transition from accumulation to distribution. If that's you, if that's your parents, if that's your future, you need to understand sequence of returns risk. You need to take it seriously. And you need to structure your retirement plan to address it. So let's do that. Let's dive in. Let's understand this risk at its core. And then let's build a framework for managing it. Because I promise you, by the time we're done, you're going to see retirement planning in a completely different way. You're going to understand why timing matters. You're going to understand why the traditional 4% rule is dangerously oversimplified. You're going to understand why a 60/40 portfolio might not be enough. And you're going to have actionable strategies that you can implement tomorrow to protect yourself. This is too important to get wrong. This is your life. This is your financial security. This is your independence. And I'm not going to let you walk into retirement blind to this risk. Not if I can help it. All right. Let's talk about what's actually happening under the surface when sequence of returns risk destroys a retirement portfolio. Because if you understand the mechanics, if you can see the mathematical reality of how this works, you'll understand why traditional retirement planning advice is often inadequate. And more importantly, you'll understand what you need to do differently. I want to start with a concept that most people find counterintuitive. During your working years, when you're accumulating wealth, volatility is essentially irrelevant to your long-term outcome. What matters is the average return over the full period. Whether the market goes up 30% in year 1 and down 20% in year 2, or down 20% in year 1 and up 30% in year 2, if you're not withdrawing money, if you're just letting it compound, you end up in the same place. The sequence doesn't matter. Only the average matters. But the moment you start making withdrawals, the moment you retire and begin living off your portfolio, this mathematical symmetry breaks down completely. Suddenly, sequence becomes everything. And the reason why is something called reverse dollar cost averaging, or sometimes it's called dollar cost ravaging. Let me explain what this means. When you're contributing to your portfolio during a market decline, you're buying shares at lower prices. This is good. This is dollar cost averaging in your favor. You're accumulating more shares per dollar contributed. When the market recovers, those shares you bought at low prices participate fully in the recovery. You benefit from the volatility. But when you're withdrawing from your portfolio during a market decline, you're forced to sell shares at lower prices. This is reverse dollar cost averaging. This is dollar cost ravaging. You're selling more shares per dollar withdrawn. And when the market recovers, you have fewer shares left to participate in that recovery. You've locked in losses. You've permanently depleted your capital base. This is the core mechanism of sequence of returns risk. It's not just that your portfolio goes down. It's that you're withdrawing from a declining portfolio, which means you're selling at the worst possible time, which means you have fewer assets to benefit from the eventual recovery, which means your portfolio never fully recovers to where it would have been if the timing had been different. Let me give you a concrete example with real numbers, because I think this is where the concept really becomes clear. Let's say you have $1 million in retirement savings. You're following the 4% rule, withdrawing $40,000 in year 1, adjusted for 3% inflation each subsequent year. You're invested 60% in stocks, 40% in bonds. Now let's look at two scenarios. Scenario 1. The market returns positive 20% in year 1, positive 10% in year 2, then negative 10% in year 3, then negative 20% in year 4, then positive 15% in years 5 through 10. The average annual return over the 10 years is about 7%. At the end of 10 years, you have approximately $1.2 million remaining. Scenario 2. We reverse the sequence. The market returns negative 20% in year 1, negative 10% in year 2, then positive 10% in year 3, then positive 20% in year 4, then positive 15% in years 5 through 10. Same exact returns, just in reverse order. Same average annual return of 7%. But at the end of 10 years, you have only approximately $850,000 remaining. Do you see what happened there? Same returns, same withdrawal rate, same average, but $350,000 difference in outcome. All because of sequence. All because of when the negative returns occurred. This is not a theoretical problem. This is mathematics. This is reality. And this is what destroys retirement plans. Now, the natural question is, how bad can this get? What's the worst case scenario? And this is where historical analysis becomes crucial. We can look back at every possible retirement date over the last 100 years and calculate what would have happened to someone who retired at each of those dates. We can measure the success rate, the failure rate, the portfolio longevity. And when we do this analysis, when we run the numbers, we see some very clear patterns. First, the worst retirement dates in modern history cluster around major market peaks followed by severe bear markets. 1929, obviously. 1937, 1966, 1973, 2000, 2007. If you retired at any of those moments, you faced significant sequence of returns risk. Your first few years of retirement coincided with major market declines. And in many cases, especially if you were withdrawing at typical rates, your portfolio suffered permanent damage. The 1966 retiree is particularly instructive. The market went essentially nowhere for the next 16 years. From 1966 to 1982, stocks had a real return close to zero after adjusting for inflation. Imagine retiring in 1966 at age 65 with what you thought was plenty of money, and then watching your portfolio barely keep pace with your withdrawals for the next 16 years. By 1982, you're 81 years old, your portfolio has been significantly depleted, and only then does the great bull market of the 1980s and 1990s begin. But you've already done so much damage that you can't fully recover. Contrast that with someone who retired in 1982. They caught the beginning of one of the greatest bull markets in history. Stocks went up for nearly 18 years straight with only minor corrections. Even following a conservative withdrawal strategy, even being cautious, that person ended up with far more money than they started with. Not because they were smarter. Not because they took more risk. But because they got lucky with timing. This brings me to a critical point about how we think about risk in retirement. In the accumulation phase, we measure risk primarily by volatility. Standard deviation. How much does your portfolio go up and down? And that's a reasonable measure when you're accumulating, because volatility without withdrawals is just noise. But in retirement, volatility with withdrawals is not noise. It's existential risk, and we need a different framework for measuring it. At BlackRock, when we analyze retirement portfolios, we don't just look at expected returns and standard deviation. We run Monte Carlo simulations. We model thousands of possible market scenarios. We test different sequences of returns. We measure failure rates. We calculate the probability of portfolio depletion at different time horizons. And what we find, consistently, is that the traditional measures of risk that we use during accumulation dramatically underestimate the risk during distribution. A portfolio that seems adequately conservative based on its volatility, based on its 60/40 or 50/50 allocation, can still have a 25% or 30% failure rate over a 30-year retirement if you're withdrawing at typical rates and you get unlucky with sequence. That's not acceptable. That's not prudent. That's gambling with your financial security. And here's something else that makes this problem worse, something that most people don't think about: inflation. When you're modeling retirement withdrawals, you can't just withdraw the same dollar amount every year. You need to adjust for inflation. Your $40,000 withdrawal in year 1 needs to become $41,200 in year 2 if inflation is 3%. Then $42,436 in year 3. And so on. This is how you maintain your purchasing power. This is how you maintain your standard of living. But here's the problem. When you're adjusting your withdrawals for inflation while your portfolio is declining, you're creating a double whammy. Your portfolio is going down because of market losses. But your withdrawals are going up because of inflation adjustments. So not only are you selling more shares because prices are down, you're also withdrawing more dollars because of inflation. This accelerates the depletion. This compounds the damage. The 1970s retiree experienced this acutely. Not only were stocks essentially flat to down for much of the decade, but inflation was running at 7%, 8%, 9%, even higher in some years. So your withdrawals are increasing dramatically to keep up with inflation, but your portfolio isn't growing to support those increased withdrawals. It's a nightmare scenario, and it's exactly the kind of scenario that sequence of returns risk models need to account for. Now, let me address something I hear frequently. People say, "Larry, I understand the math. I understand that sequence matters. But doesn't this average out over time? If I have a 30-year retirement, doesn't the sequence risk diminish as I get further from the early years?" And the answer is, yes, sequence risk does diminish over time. But the critical period is the first 10 years. The first 5 years especially. If you get through the first decade of retirement without a major bear market, your odds of success go up dramatically. But if you experience a severe decline in the first 5 years, the damage can be so significant that you never recover, even if the subsequent 25 years are good. This is what I mean when I say sequence of returns risk is front-loaded. It's not evenly distributed across your retirement. The early years matter disproportionately. And the reason is mathematical. In the early years, your portfolio balance is at its highest. Your withdrawal rate is at its lowest as a percentage of the balance. If the market crashes, you're forced to sell a large number of shares at depressed prices, which means a huge amount of your future growth potential is eliminated. Later in retirement, your balance is lower, so a market crash affects a smaller absolute dollar amount. The leverage effect is different. Think of it like compound interest in reverse. In the accumulation phase, early contributions benefit from more years of compounding, so they have disproportionate impact on your final wealth. In the distribution phase, early market crashes create reverse compounding, selling off shares that would have generated growth for decades. The timing of losses matters enormously because of this compound effect. This is why the advice to just stay invested, and ride it out, and don't panic during retirement is often inadequate. Yes, staying invested is generally the right approach. Yes, panic selling is generally the wrong approach. But if you're retired and taking withdrawals, you can't just ride it out without consequences. Every withdrawal during a downturn is permanent damage. Every share you sell at a low price is a share that won't participate in the recovery. You need strategies beyond just staying invested. You need a buffer. You need optionality. You need a plan that specifically addresses the sequence problem. Let me also talk about something that doesn't get discussed enough in the context of sequence of returns risk: behavior. The mathematics is one thing. The psychology is another. And in retirement, psychology matters as much as mathematics. Maybe more. Imagine you're 68 years old. You retired 3 years ago. The market has fallen 40%. Your $1 million portfolio is now $600,000. You're supposed to take out another $42,000 this year to live on. But that means you're withdrawing 7% of your remaining balance. And every time you check your account, which you probably shouldn't be doing but everyone does, you see it getting smaller. You see the number declining. And the fear starts to build. The anxiety, the sleepless nights, the conversations with your spouse about whether you need to go back to work, the stress. This is the psychological reality of sequence of returns risk. It's not just a number on a spreadsheet. It's not just a failure rate in a Monte Carlo simulation. It's lived experience. It's emotional. It's terrifying. And under that kind of stress, people make mistakes. They panic sell. They go to cash. They drastically reduce their spending and compromise their quality of life. They make decisions that lock in losses and prevent recovery. I've seen this happen countless times. I've had conversations with retirees who are living in fear, who have stopped enjoying their retirement because they're so worried about their portfolio. And often, these are people who did everything right. They saved diligently. They invested prudently. They followed the conventional wisdom. But they got unlucky with timing. And now they're suffering the consequences not just financially, but emotionally and psychologically. This is why I'm so passionate about addressing sequence of returns risk proactively. It's not just about the money. It's about giving people peace of mind. It's about allowing people to enjoy their retirement without constant anxiety about their portfolio. It's about creating a financial structure that can withstand market volatility without requiring heroic emotional discipline from retirees who are supposed to be relaxing and enjoying the life they worked so hard to build. At BlackRock, we've studied investor behavior during market crises. We've looked at who sells, who holds, who buys. And what we find is that retirees who are taking withdrawals are far more likely to panic sell than younger investors who are still accumulating. The reason is obvious. When you need that money to live on, when that portfolio balance represents your food, your housing, your healthcare, the emotional stakes are much higher. You can't afford to take the long view in the same way. This is why retirement planning isn't just financial planning. It's psychological planning. It's building a structure that not only works mathematically but also works emotionally. A structure that gives you permission to not panic when markets fall. A structure that allows you to sleep at night. A structure that lets you enjoy your retirement. And here's what institutional investors have known for decades but individual investors are only beginning to understand. The way to address sequence of returns risk isn't to avoid stocks. It isn't to go conservative and sit in bonds and cash. That creates a different problem, the problem of insufficient growth to sustain a long retirement. The way to address it is through strategic diversification and through creating what we call a retirement income floor. The income floor concept is simple but powerful. You structure your portfolio so that your essential expenses, the must-haves, are covered by sources of income that are not subject to market volatility. Social security, pensions if you have them, annuities, bonds held to maturity, tips, stable value funds. These create a floor below which your income cannot fall, regardless of what the stock market does. And then above that floor, you have your growth portfolio, your stocks, your risk assets. The things that will allow your wealth to compound over a 30-year retirement. The beauty of this structure is that it solves both the sequence problem and the psychological problem simultaneously. Mathematically, you're not forced to sell stocks during downturns to cover essential expenses. You have the income floor for that, so you can ride out the volatility without selling at bad prices. And psychologically, you know that your core needs are covered. You can tolerate the volatility in your growth portfolio because it's not money you need today. It's money for 10 years from now, 20 years from now. It's money that has time to recover. This is how pension funds think. This is how endowments think. They match their liabilities with appropriate assets. Short-term liabilities get matched with stable assets. Long-term liabilities can be funded with growth assets. Individual retirees should think the same way. But most don't. Most have a single portfolio that's supposed to do everything, provide current income, generate growth for the future, and remain stable during downturns. That's asking too much from a single portfolio structure. Now, I want to address the classic retirement rule that everyone has heard of, the 4% rule. This rule says that if you withdraw 4% of your portfolio in the first year of retirement, then adjust that dollar amount for inflation each year, your portfolio should last 30 years with a high degree of confidence. This rule came from research in the 1990s by a financial planner named William Bengen, and it's been the foundation of retirement planning ever since. But here's what people don't understand about the 4% rule. It was specifically designed to address sequence of returns risk. Bengen tested it against the worst historical retirement dates. He looked at the 1929 retiree, the 1966 retiree, the 1973 retiree, and he found that 4% worked even in those worst-case scenarios. The portfolio lasted 30 years. Sometimes it lasted with plenty left over. Sometimes it was nearly depleted. But it lasted. However, and this is crucial, the 4% rule makes some very specific assumptions. It assumes a 50-50 or 60-40th stock-bond allocation. It assumes you rebalance regularly. It assumes relatively low fees. It assumes you don't panic and change your strategy during downturns. And most importantly, it's based on historical returns from U.S. stocks and bonds over the 20th century, which were exceptionally strong compared to global averages and compared to what we might reasonably expect going forward. In today's environment, with lower bond yields, with potentially lower future stock returns, with longer life expectancies, many researchers believe the safe withdrawal rate is actually lower than 4%. Maybe 3% to 3.5%. And if that's true, then the amount of money you need to retire comfortably is significantly higher than you think. If you need $40,000 a year and the safe rate is 4%, you need $1 million. But if the safe rate is 3%, you need $1.33 million. That's a big difference. This is part of why I'm concerned about the retirement readiness of so many Americans. They've been planning based on rules and assumptions that may no longer be valid. They've been told that $1 million is enough. But depending on when they retire, depending on the sequence of returns they experience, depending on how long they live, it might not be enough. And by the time they figure that out, it's too late to go back to work. It's too late to save more. They're stuck. This is the retirement crisis I talk about in my annual letters. This is why we're working so hard at BlackRock to create better solutions, to provide access to better asset classes, to help people build more resilient portfolios. Because the traditional approach isn't working for too many people. The 60-40ths portfolio, the 4% rule, the set it and forget it mentality, these worked reasonably well in the past, but they're insufficient for the challenges retirees face today. So where does that leave us? We've established that sequence of returns risk is real. We've seen the mathematics of how it works. We've looked at historical examples. We've discussed the psychological dimension. We've talked about why traditional approaches are inadequate. Now the question is, what do we do about it? How do we structure portfolios and withdrawal strategies to specifically address this risk? How do we give retirees the confidence that their money will last, regardless of when they retire? That's what we need to explore next. The solutions, the strategies, the specific tactics that work. Because understanding the problem is critical, but solving the problem is what matters. All right, let's talk about solutions. Because understanding sequence of returns risk is only valuable if we can do something about it. And we can. There are specific, proven strategies that reduce this risk dramatically. Strategies that institutional investors have used for decades. Strategies that we're now making available to individual retirees. Let me walk you through the most effective approaches. The first and most important strategy is what I call dynamic withdrawal management. The traditional approach to retirement withdrawals is to set a fixed dollar amount in year 1, then increase it by inflation every year regardless of market conditions. You withdraw $40,000 in year 1, then $41,200 in year 2, then $42,436 in year 3, and so on, forever, until the money runs out or you die. This is what the 4% rule prescribes. And it's dangerously inflexible. Think about what this means in practice. The market crashes 30% in year 1 of your retirement. Your portfolio goes from $1 million to $700,000. But under the traditional approach, you still withdraw $41,200 in year 2 because that's the inflation-adjusted amount. You're withdrawing 5.9% of your remaining portfolio. The market stays down for another year. You're down to $600,000. You withdraw $42,436 in year 3. Now you're withdrawing 7.1% of your balance. You see how quickly this spirals? You're locked into increasing withdrawals from a decreasing portfolio. This is the mechanism that destroys retirement plans. Dynamic withdrawal management says, adjust your withdrawals based on portfolio performance. In good years, when the market is up, you can afford to withdraw more. Maybe 4.5% or 5% of your current balance. Take that vacation. Help your kids. Enjoy the abundance. But in bad years, when the market is down, you tighten your belt. You withdraw 3% or 3.5%. You cut discretionary spending. You postpone the big purchases. You give your portfolio room to recover. Now, I know what you're thinking. Larry, that sounds great in theory, but I can't just reduce my spending by 30% when the market crashes. I have fixed expenses. I have a mortgage. I have healthcare costs. And you're absolutely right. This is why we need the second strategy, which I mentioned earlier, creating an income floor. The income floor approach divides your spending into 2 categories: essential expenses and discretionary expenses. Essential expenses are the things you absolutely must pay for: housing, food, utilities, insurance, healthcare, minimum transportation. These are your non-negotiables. And for these expenses, you need guaranteed income sources that are not subject to market volatility. Social Security covers part of this. If you have a pension, that covers more. But for most people, there's a gap. You need more guaranteed income than Social Security and pensions provide. This is where different asset classes come in. TIPS, Treasury inflation-protected securities, are perfect for creating an income floor. You can build a TIPS ladder that generates inflation-adjusted income every year for the next 10 or 15 years. You know exactly what you're going to get. It's guaranteed. It adjusts for inflation. And it's backed by the U.S. government. You cannot lose money on TIPS held to maturity, not in real terms. Alternatively, some retirees use immediate annuities to create an income floor. You give an insurance company a lump sum, and they give you guaranteed monthly payments for life. The amount depends on your age and current interest rates. But once it's set up, you have that income for as long as you live. It removes longevity risk. It removes market risk for that portion of your spending. And it gives you psychological peace. Let me be clear about something. I'm not saying everyone should annuitize their entire portfolio. That would be a mistake. Annuities have drawbacks. They're illiquid. They don't leave anything for your heirs. They're subject to the insurance company's financial strength. And in a low interest rate environment, the payout rates can be unattractive. But for a portion of your portfolio, specifically the portion that needs to cover essential expenses, annuities can be an effective tool. They transfer the sequence of returns risk from you to the insurance company. And insurance companies are very good at managing that risk because they have a large, diversified pool of annuitants. So here's how this works in practice. Let's say you need $60,000 a year to live on in retirement. Social Security provides $30,000. That's half. You need another $30,000 from your portfolio. You could take the traditional approach and withdraw that $30,000 from your $1 million portfolio, which is a 3% withdrawal rate, very conservative. But you're still exposed to sequence risk. If the market crashes early, that $30,000 becomes a much larger percentage of your declining balance. Or, you could use the income floor approach. Take $400,000 of your portfolio and build a TIPS ladder or purchase an annuity that generates that $30,000 per year. Now your essential expenses are fully covered. The remaining $600,000 is your growth portfolio. This is invested in stocks, in real estate, in private markets, in assets that can compound over the next 30 years. And here's the key. You don't touch this growth portfolio during market downturns. You let it recover. You let it compound. You only draw from it during good years, and only for discretionary spending. This structure solves the sequence problem because you're never forced to sell stocks at bad prices to cover essential expenses. Your essentials are covered by the income floor. The growth portfolio has time to recover from downturns because you're not liquidating it. And psychologically, you can sleep at night because you know you're not going to run out of money for the things that matter most. Now, the third strategy for managing sequence of returns risk is what we call bucketing or time segmentation. This is a refinement of the income floor concept, but it adds more granularity. Instead of dividing your portfolio into just two buckets, income floor and growth, you divide it into multiple buckets based on time horizons. Bucket 1 is your immediate spending money. Cash and short-term bonds. Enough to cover 1 to 2 years of expenses. This bucket doesn't grow much, but it's completely stable. You're never selling stocks to fund current spending. You're drawing from this bucket. Bucket 2 is your near-term money, 3 to 10 years out. This is invested in intermediate bonds, dividend-paying stocks, maybe some REITs. Moderate growth, moderate stability. Bucket 3 is your long-term money, 10 years and beyond. This is your aggressive growth bucket. Stocks, international equities, private equity if you have access, real estate, alternative investments. This bucket can be volatile because you're not touching it for a decade or more. It has time to recover from any downturn. The beauty of bucketing is that it matches your assets with your time horizon. Short-term needs are funded with stable assets. Long-term needs are funded with growth assets. And you refill the buckets systematically. When bucket 1 runs low, you refill it from bucket 2. When bucket 2 runs low, you refill it from bucket 3. And you do this refilling during good years, when asset prices are high. You're never forced to sell from bucket 3 during a market crash because buckets 1 and 2 have enough to carry you through. This is exactly how pension funds operate. They have current obligations, retirees who need checks this month. They have intermediate obligations, people who are retiring in 5 years. They have long-term obligations, workers who are 30 years from retirement. And they structure their asset allocation to match these different time horizons. Individual retirees should think the same way. But most don't because nobody's explained it to them. They've been taught to think of their portfolio as a single monolithic thing. But it shouldn't be. It should be segmented by time horizon. The fourth strategy, and this is critical, is maintaining adequate liquidity throughout retirement. I see too many retirees who have their entire portfolio tied up in investments that can't be easily liquidated. Real estate, private equity, illiquid alternative investments. And when they need cash, they're forced to sell at inopportune times or take loans against their assets at unfavorable terms. Liquidity in retirement is not just about having cash in the bank. It's about having optionality. It's about not being forced to make financial decisions under duress. If you have adequate liquidity, you can wait out market downturns. You can delay Social Security to get a higher benefit. You can choose when to recognize capital gains for tax purposes. You can take advantage of opportunities when they arise. Liquidity gives you control, and control reduces risk. At BlackRock, when we construct retirement portfolios, we always include a substantial liquidity buffer. Not because we think cash is going to generate great returns. It's not, but because liquidity is a form of insurance. It's protection against forced asset sales. And the value of that insurance is enormous, especially during the critical first 10 years of retirement when sequence risk is highest. Now let me talk about asset allocation in retirement, because this is where a lot of people get it wrong. The traditional guidance is to become more conservative as you age. Start at 70% stocks, 30% bonds when you're young. Move to 60/40ths in middle age. Then 50/50 or even 40/60ths in retirement. The idea is that as you have less time to recover from market downturns, you should take less risk. But here's the problem with this conventional wisdom. It doesn't account for sequence of returns risk specifically. A 50/50 portfolio feels conservative. It has lower volatility than a 70/30ths portfolio. But if you're taking withdrawals and the stock portion crashes early in retirement, you can still run out of money. The risk isn't just volatility. The risk is portfolio depletion. And portfolio depletion risk is a function of withdrawal rate, portfolio size, time horizon, and yes, sequence of returns. What we've found through extensive modeling is that the optimal asset allocation in retirement is actually more complex than a simple age-based glide path. It depends on how much of your spending is covered by guaranteed income sources. If you have a pension that covers 70% of your expenses, you can afford to be more aggressive with your portfolio because you're not reliant on it for current income. But if you have no pension and Social Security covers only 30% of your expenses, you need to be more conservative, or you need to structure your portfolio with that income floor I mentioned. It also depends on your flexibility. If you can reduce your spending by 20% or 30% in bad years without significant hardship, you can afford more equity exposure. But if your spending is rigid, if you can't adjust, you need more conservative positioning or you need that bucketing structure. And it depends on your longevity expectations. If you're healthy and have a family history of longevity, you might live to 100. That's a 35-year retirement if you retire at 65. You need growth. You can't be too conservative or inflation will erode your purchasing power. But if you have health issues and might only live to 80, that's a 15-year retirement. Different calculation. Different risk profile. This is why one-size-fits-all retirement advice is so dangerous. Your situation is unique. Your risk tolerance is unique. Your spending flexibility is unique. Your longevity expectations are unique. And your retirement portfolio should reflect that uniqueness. But most people get generic advice. Be in a 60/40ths portfolio. Follow the 4% rule. It's inadequate. At BlackRock, we're moving toward much more personalized retirement solutions. Using technology, using data, using sophisticated modeling, we can create customized glide paths, customized withdrawal strategies, customized asset allocations that reflect an individual's specific circumstances. We're not there yet for everyone. This kind of personalization has traditionally been available only to ultra-high net worth clients. But we're working to democratize it, to make it accessible to anyone saving for retirement. Now, let me address something that's becoming increasingly important: the role of alternative investments in retirement portfolios. For decades, the standard retirement portfolio was stocks and bonds. Maybe some cash. That was it. And for much of that time, it worked reasonably well. Bonds provided steady income and stability. Stocks provided growth. The two asset classes had low correlation, meaning when stocks went down, bonds often went up or stayed stable. But that relationship broke down in 2022. Both stocks and bonds fell at the same time. Why? Because the driver was inflation and rising interest rates, which hurt both asset classes. And this revealed a fundamental weakness in the traditional 60/40ths portfolio. It's not truly diversified. It's diversified across two asset classes, but both of those asset classes are sensitive to the same macroeconomic factors. This is why I've been advocating for what I call the 50/30/20ths portfolio. 50% stocks for growth, 30% bonds for income and stability, and 20% alternatives, real assets, infrastructure, private credit, private equity. These assets have low correlation to public stocks and bonds. They provide different sources of return. They respond to different economic forces. And they enhance the resilience of the overall portfolio. Now, I understand that alternative investments have traditionally been inaccessible to most individual investors. Minimum investments of $100,000 or more. Accredited investor requirements. Long lock-up periods. Complexity. But that's changing. We're seeing the democratization of alternatives. We're creating vehicles that allow ordinary investors to access infrastructure funds, private credit funds, even private equity, with much lower minimums and more liquidity. For retirees, alternatives are particularly valuable because they can generate income that's not tied to public market volatility. Infrastructure assets like toll roads, airports, utilities, they generate steady cash flows regardless of what the stock market is doing. Private credit provides high income in a floating rate structure, which means as interest rates rise, the income rises. These are exactly the kinds of assets that help manage sequence of returns risk. I also want to talk about tax planning in retirement, because taxes have an enormous impact on how long your money lasts, and most people don't think about this strategically. When you're retired and taking distributions, every dollar you withdraw has a tax consequence. Traditional IRA withdrawals are taxed as ordinary income. Capital gains from selling stocks in a taxable account are taxed at capital gains rates. Roth IRA withdrawals are tax-free. The sequence in which you draw from different account types matters tremendously. The conventional wisdom is to withdraw from taxable accounts first, then tax-deferred accounts, then Roth accounts last. The idea is to let tax-advantaged accounts compound as long as possible. But this isn't always optimal. Sometimes it makes sense to do Roth conversions in early retirement, moving money from traditional IRAs to Roth IRAs during low-income years, paying the tax at a lower rate, and then having tax-free withdrawals later. Sometimes it makes sense to realize capital gains strategically, taking advantage of the 0% capital gains rate for people in lower tax brackets. Sometimes it makes sense to delay Social Security and live off portfolio withdrawals in the meantime, because every year you delay Social Security up to age 70, your benefit increases by about 8%. That's a guaranteed 8% return, hard to beat. The point is, tax planning in retirement is complex. It requires modeling. It requires scenario analysis. And it can easily add hundreds of thousands of dollars to your net lifetime wealth if done correctly. But most people don't do it. They just start taking distributions without a tax strategy. And they overpay. They leave money on the table. Let me bring this all together with a comprehensive framework for managing sequence of returns risk. If I were sitting down with a client who's about to retire or recently retired, here's what I would recommend. First, calculate your essential expenses and your discretionary expenses. Be honest. Be detailed. Know the difference between needs and wants. Second, identify all sources of guaranteed income. Social Security, pensions, rental income if it's stable. Calculate the gap between guaranteed income and essential expenses. Third, create an income floor to cover that gap. Tips ladder, annuities, short-term bonds, whatever makes sense for your situation. But cover those essential expenses with assets that aren't subject to market risk. Fourth, structure your remaining portfolio using a bucketing approach. Near-term bucket for years 1 to 3. Intermediate bucket for years 4 to 10. Long-term bucket for beyond 10 years. Match the risk level of each bucket to its time horizon. Fifth, implement dynamic withdrawal rules. In good years, you can spend more. In bad years, you cut discretionary spending. Have that conversation with your spouse. Have a plan for what you'll cut if markets fall 30%. Sixth, maintain adequate liquidity. At least 1 year of expenses in cash. Maybe 2 years. This gives you optionality. This prevents forced sales. Seventh, think about alternatives. Not the entire portfolio, but 10% to 20% in assets that aren't correlated to stocks and bonds. Infrastructure, private credit, real estate beyond your home. Eighth, develop a tax strategy. Model different withdrawal sequences. Consider Roth conversions. Optimize your Social Security claiming strategy. And ninth, review and adjust annually. Your situation will change. Markets will change. Your spending needs will change. Your health will change. This isn't a set it and forget it plan. This is a living plan that needs to be monitored and adjusted. Now, I want to be realistic about something. This framework requires work. It requires discipline. It requires knowledge. And for many people, it requires working with a qualified financial advisor who understands sequence of returns risk and knows how to implement these strategies. Not all advisors do. Many advisors are still using traditional approaches that don't adequately address this risk. If you're going to work with an advisor, ask them about sequence of returns risk. Ask them how they address it. Ask them about dynamic withdrawal strategies. Ask them about income floors and bucketing. If they don't know what you're talking about, find a different advisor. This is too important to leave to someone who doesn't understand the risks. At BlackRock, we're training advisors. We're providing tools and resources to help them implement these strategies. We're creating products that make it easier to build resilient retirement portfolios. Because we see this as one of the defining challenges of our time. We have an aging population. We have longer lifespans. We have inadequate savings. We have volatile markets. And we have sequence of returns risk that can destroy even well-planned retirements. We need better solutions. And we're committed to building them. Let me close with this. Retirement should be a time of freedom. A time of enjoyment. A time to do the things you've always wanted to do but couldn't because you were working. It should not be a time of financial anxiety. It should not be a time of constant worry about whether your money will last. And with the right planning, with the right strategies, with the right structure, it doesn't have to be. Sequence of returns risk is real. It's significant. It can devastate a retirement portfolio if you're unlucky with timing. But it's manageable. It's not some mysterious, unavoidable force. It's a quantifiable risk that can be measured, modeled, and mitigated through intelligent portfolio design and disciplined withdrawal management. The people who succeed in retirement, The people who live comfortably and confidently for 30 or 40 years without running out of money, they're not necessarily the people with the most money. They're the people who understand the risks they face and structure their portfolios to address those risks. They're the people who think about retirement income as a multi-decade challenge that requires different strategies at different stages. They're the people who create income floors, who use bucketing, who maintain liquidity, who adjust their spending based on market conditions, who think about taxes strategically. And here's the thing. None of this is beyond your capability. You don't need to be a financial genius. You don't need a PhD in economics. You just need to understand the basic principles, implement them systematically, and have the discipline to stick with the plan even when it's uncomfortable. That's what I've tried to give you today. An understanding of sequence of returns risk, a framework for thinking about it, and specific strategies for managing it. If you take nothing else from this conversation, take this. The timing of your retirement relative to market cycles matters enormously. If you retire at the wrong time and don't have strategies in place to address sequence risk, you are vulnerable. But if you understand this risk, if you structure your portfolio appropriately, if you manage your withdrawals dynamically, you can retire with confidence regardless of market conditions. We've covered a lot of ground. We've looked at the mathematics, the history, the psychology, and the solutions. And I hope you're walking away with a much deeper understanding of why retirement planning is so much more complex than just accumulating a number. It's about creating a structure that can sustain you through multiple market cycles, through periods of inflation, through your 70s, 80s, 90s, and possibly beyond. The retirement landscape is challenging, but it's not insurmountable. With the right knowledge, the right strategies, and the right discipline, you can build a retirement that lasts. You can create financial security that gives you the freedom to enjoy the life you've worked so hard to build. And that's what this is all about. Not accumulating wealth for its own sake, but creating the security and freedom that allows you to live well, to help the people you care about, and to make the most of the time you have. Sequence of returns risk is the retirement threat nobody talks about. But now you know about it. Now you understand it. Now you can protect yourself from it. And that knowledge, that awareness, that preparation, it could be the difference between a retirement that's stressful and anxious and a retirement that's comfortable and confident. Choose wisely, plan carefully, and build a retirement structure that works for you regardless of when you retire or what the markets do. Because you've earned it, you've worked for it, and you deserve to enjoy it without fear.